Commissioner of Gift Tax and Nakolam vs. Abdul Karim Mohammed, dead by LRS on 10 July 1991. Supreme Court of India. Equivalent citation 1991 AIR 1847, 1991 SCR 2846. Bench Shetty KJ and Yogeshwar Dayal. In this case, the petitioner was Commissioner of Gift Tax in Nakolam and the respondent was Abdul Karim Mohammed. So let's go through the sections which were mentioned in this case law. The first one is Section 2, Clause 12 in the Gift Tax Act 1958 defines about gift. Gift means the transfer by one person to another of any existing movable or immovable property made voluntarily and without consideration in money or money's worth, and includes transfer or conversion of any property referred to in Section 4 deemed to be gift under that section. Explanation. A transfer of any building or part therefore referred to in Clause 3, Clause 3A or Clause 3B of Section 27 of the Income Tax Act by the person who is deemed under the said clause to be the owner thereof made voluntarily and without consideration in money or money's worth shall be deemed to be gift made by such person. So let's just clarify it a little bit. Section 211 of the Gift Tax Act 1958 states that when one transfers her or his movable or immovable property to another without any consideration, it also includes conversion of property as Section 4 states, is gift. Well, sounds good, but I prefer complexity over simplicity. So I can also interpret it as when one transfers her or his movable or immovable property to another without asking for any tangible consideration, it is called gift. It also includes conversion of property as Section 4 of the Gift Tax Act 1958. So what does the Section 4 of the Gift Tax Act states? It states about gifts to include certain transfers. Section 4 gives to include certain transfers. 1. For the purpose of this Act. A. Where property is transferred otherwise than for adequate consideration, the amount by which the value of the property as on the date of the transfer and determined in the matter date found in the schedule. 2. Exceeds the value of the consideration shall be deemed to be a gift made by the transferor, provided that nothing contained in this clause shall apply in any case where the property is transferred to the government or where the value of the consideration for the transfer is determined or approved by the central government or the Reserve Bank of India. B. Where property is transferred for a consideration which, having regard to the circumstances of the case, has not passed or is not intended to pass either in full or in part from the transferee to the transferor. The amount of the consideration which has not passed or is not intended to pass shall be deemed to be a gift made by the transferor. C. Where there is a release, discharge, surrender, forfeiture or abandonment of in any debt, contract or other actionable claim or any interest in property by any person, the value of the release, discharge, surrender, forfeiture or abandonment to the extent to which it has not been found to the satisfaction of the assigning officer to have been bona fide shall be deemed to be a gift made by the person responsible for the release, discharge, surrender, forfeiture or abandonment. D. Where a person absolutely entitled to property causes or has caused the same to be vested in whatever manner in himself and any other person jointly without adequate consideration, and such other person makes an appropriation from or out of the said property, the amount of appropriation used for the benefit of the person making the appropriation or for the benefit of any other person shall be deemed to be a gift made in his favor by the person who caused or has caused the property to be so vested. E. Where a person who has an interest in property as a tenant for a term or for life or a remainder man surrenders or relinquishes his interest in the property or otherwise allows his interest to be terminated without consideration or for a consideration which is not adequate, the value of the interest so surrounded, relinquished or allowed to be terminated, or as the case may be, the amount by which such value exceeds the consideration received shall be deemed to be a gift made by such person. 2. Where in the case of an individual being a member of a Hindu undivided family, any property having been the separate property of the individual has been converted by the individual into a property belonging to the family through the act of impressing such separate property with the character of property belonging to a family or throwing it into the common stock of the family, such property being hereafter in the subsection referred to as the converted property, then notwithstanding anything contained in any other provision of this act or any other law for the time being imposed, for the purpose of compulsion of the taxable gifts made by the individual shall be deemed to have made a gift of so much of the converted property as the member of the Hindu and divided family, other than such individual would be entitled to if a partition of the converted property had taken place immediately after such conversion. Well, that was lengthy, so we're gonna split it up. So, to put it in simple words, we can also state that Section 4, subsection A states that if a property is transferred without paying or receiving the amount which was supposed to, or without adequate or ample consideration, and also by obeying the manner in Schedule 2, then it is a gift. Schedule 2, Section 1, Value of gifted property. How to be determined? Subject to the provisions of Rule 2 to 7, the value of any property other than cash transferred by the way of gift shall, for the purpose of this Act, be determined in accordance with the provisions of Schedule 3 to the Wealth Tax Act 1957, hereafter referred as the Wealth Tax Act, which shall apply subject to the following modifications, namely, in the said schedule, A. References by whatever form of words in the Wealth Tax Act shall be construed as references to this Act. B. In the Rule 5, the reference of the year ending on the valuation date shall be construed as a reference to the previous year as defined in this Act. C. Save as provided in Clause B, references to the valuation date shall be construed as references to the date on which the gift was made. D. Reference to Section 7 of the Wealth Tax Act shall be construed as references to Section 6 of this Act. E. References to Section 16A of the Wealth Tax Act shall be construed as references to subsection 6 of the Section 15 of this Act. After splitting it up in digestible pieces, I can state that Schedule 2, Section 1, value of any property will be determined by this Act, but the cash transferred by way of gift will be determined in accordance with the provisions of Schedule 3 of the Wealth Tax Act 1957, which we will discuss after some couple of minutes, I assume. B. In Rule 5, on the ending of the year, on the valuation date shall be interpreted or construed to the previous year as defined in this Act. C. Clarifies that the references of the valuation date as mentioned in Clause B shall be construed or interpreted as references made on the date when the gift was made. As well as we all know, in our legal world, spoken words are indeed precious, maybe not as much as written ones. And in Clause D states that Section 7 equals to Section 6, and according to Clause E, Section 16A equals to Section 15 of this Act. The Wealth Tax Act 1957. Schedule 3. Section 2. Definitions. In this schedule, unless the context otherwise requires, 1. Accounting year, in relation to a company, means a period in respect of which any profit and loss account of the company laid before it in the annual general meeting is made up. 2. Debenture includes debenture stock, bonds, and any other securities of a company, whether consisting a charge on the assets of the company or not. 3. Equity share means any share in the share capital of a company other than a preference share. 4. Gold means gold, including its alloy, whether virgin, melted, remelted, wrought, or unwrought, in any shape or form, of a purity of not less than 9 carats, and includes any gold coin, whether legal tender or not, any gold ornament or other article of gold. 5. Gold ornament means any article in a finished form meant for personal adornment or for the adornment of any idol, deity, or any other object of religious worship made of or manufactured from gold, whether or not service stones or gems, real or artificial, or with pearls, real, cultured, or imitation, or with all, or any of them, and includes parts, pendants, or broken pieces of gold ornaments. 6. Investment company means a company whose gross total income consists mainly of income which is chargeable to income tax under the heads income from house property, capital gains, and income from other sources. Explanation. In this clause, the expression gross total income shall have the meaning assigned to it in Section 80B of the Income Tax Act. 7. Jewelry includes A. Ornaments made of gold, silver, platinum, or any other precious metal, or any alloy containing one or more of such precious metals, whether or not containing any precious or semi precious stones, and whether or not worked or sewn into any wearing apparel. B. Precious or semi precious stones, whether or not set in furniture, utensils, or any other article, or worked or sewn into any apparel. 8. Preference share has the meaning assigned to it in Section 85 of the Companies Act 1956. 9. Quoted shares or quoted debentures in relation to an equity share or a preference share or as the case may be. A debenture means a share or debenture quoted on any recognized stock exchange with regularity from time to time, whether the quotations of such shares or debentures are based on current transactions made in the ordinary course of business. Explanation. Where any question arises whether a share or debenture is quoted share or an quoted debenture within the meaning of this clause, a certificate to the effect furnished by the concerned stock exchange in the prescribed form shall be accepted as conclusive. 10. Recognized stock exchange has the meaning assigned to it in Clause F of the Section 2 of the Securities Contracts Regulation Act 1956. 11. Unquoted shares or unquoted debentures in relation to any equity share on a preference share or, as the case may be, a debenture means a share or debenture which is not quoted share or a quoted debenture. I assume we all got the essence of this section, but I would like to stretch it up a little bit more. An account year is the period during which the financial statements of a company are prepared. As we all know, a company prepares every year a balance sheet, profit and loss account, and cash flow for the presentation of its financial records. In India, accounting year begins from April 1 and ends on March 31st. There are many reasons why India didn't adopt the calendar year as a financial year. One reason is the increased sale during the October, November, and December due to festivals and the corresponding increase in complexity of accounting. And we cannot overlook the matter that around April March, Hindu New Year takes place, which is based on the lunar calendar. Different parts of India celebrate it in their own way. Due to being under British Empire for quite a long time, hence, accounting systems on India is influenced by British. The British calendar year, which India follows, is based on Georgian calendar. There is an interesting story behind it. The British government chose to use the Georgian calendar, but before doing this, they decided to change the date of the new year to January 1st. Till then, the first day of the year had always been March 25, also known as Lady Day. The financial year used to be March 25 to December 31st in England and its colonies around the world. But in 1752, the English government agreed to start the new year on January 1st. The accountants felt that changing the date would be unjust and rebelled against it. Hence, the financial year continued to be followed from April 1st. An Indian crop circle is also around April-March. In United Kingdom, the financial year starts from April 6 and ends on 5th April. On the other hand, New Zealand's accounting year begins from April 1 to March 31st. United States is quite different from other countries. It is from October 1st to September 30. Philippines government's fiscal year begins from 1st January and ends on 31st December. Next is the word debenture. It is a derivation of the Latin word debere, which can be interpreted as borrow or loan. So basically, debentures are written instruments of debt that companies issue under the common sale. Some examples of debentures are treasury bonds and treasury bills. So, debenture is a type of bond or other debt instrument that is unsecured by collateral. Since debentures have no collateral banking, they must rely on the creditworthiness and reputation of the issuer for support. Corporation and government both frequently issue debentures to raise capital or funds. They are similar to loan certificate, and they are actually the most common way for large companies to borrow money. Ordinary share is a part ownership where each and every member possesses a fragment of ownership. These types of shareholders in any organization possess the right to vote. Equity share is one of the most preferential share. A person who holds equity share has a right to vote in the company's decisions. Of course, it will depend on how much share the person holds. As an equity shareholder, you are entitled to receive a claim to any profits paid by the company in the form of dividends. Now, our beloved gold, and if you are one of those who isn't aware of this medal, AU, then congratulations! You are an alien and welcome to our beloved planet. I wish you to succeed in whatever mission you are dealing with, and only if it is for the welfare of us and you. Thank you. The next is an investment company, which is a corporation or trust engaged in the business of investing the pooled capital of investors in financial securities. According to law, investment company means a company which will produce gross total income, and the gross total income will be chargeable to income tax. Under the heads, or we can say under the names, under income from house property, capital gains, or income from other sources like business or other stuffs. An investment company often achieves its goal through a closed-end fund or an open-end fund. The most well-known name for this is mutual funds, and I'm sure that you all have heard about it, right? So, what is preference share? Preference shares allow an investor to own a stake at the issuing company with the condition that whenever the company decides to pay dividends, the holder of the preference shares will be the first to be paid. And whenever you buy any kind of share, you will receive a stock certificate, and which is actually a physical piece of paper, but online ones are intangible. We can also define preferred stock through an illustration of how they work. As an example, suppose that a company C has a total of 10,000 preference shares to distribute among its investors. These shares are priced at 100 rupees, earning interests at 8% per annum. For the years of 2018 and 2019, C company has not paid dividends to its preference shareholders. Before the company can pay its regular shareholders in 2020, the preference shareholders are eligible to receive 2,40,000 by the time 2020 turn around. This amount is cumulative divided earned after 3 years for all the shareholders. Preference shareholders will get priority before other shareholders when the company starts paying its dividends, as I have told you. Section 85 of the Companies Act 1956 defines preference share capital. Preferential capital means with reference to any company limited by shares, whether formed before or after the commencement of this act. That part of the share capital of the company which fulfills both the following requirements, namely A. That as respects dividends, it carries or will carry a preferential right to be paid a fixed amount or an amount calculated at a fixed rate, which may be either free of or subject to income tax, and B. That as respects capital, it carries or will carry, on a winding up or repayment of capital, a preferential right to be repaid the amount of the capital paid up or deemed to have been paid up, whether or not there is a preferential right to the payment of either or both of the following amounts, namely 1. Any money remaining unpaid in respect of the amount specified in Clause A up to the date of the winding up or repayment of capital, and 2. Any fixed premium or premium on any fixed scale specified in the memorandum or articles of the company. Explanation: capital shall be deemed to be preference capital, notwithstanding that it is entitled to either or both of the following rights, namely 1. That as respects dividends, in addition to the preferential right to the amount specified in Clause A, it has a right to participate, whether fully or to a limited extent, with capital not entitled to the preferential right aforesaid. 2. That as respects capital, in addition to the preferential right to the payment on a winding up of the amount specified in Clause B, It has a right to participate, whether fully or to a limited extent, with capital not entitled to that preferential right in any surplus which may remain after the entire capital has been repaid. Subsection 2. Equity share capital means with reference to any such company or share capital which is not preference share capital. Subsection 3. The expressions preference share and equity share shall be construed accordingly. To put it in simple words, we can say preference share capital possesses a fixed amount or an amount calculated at a fixed rate, which will be either free or which will have to pay income tax. In these kinds of share, it is guaranteed that the owner of the share will receive the capital they paid in order to buy the said share. The preferential right to the payment of both or one of them is present or not. 1. Up to the date of the payment of the capital, and 2. Capital should be both preference and capital or any one of them. Basically, those lines are giving this section will of steel. It's guaranteed that the owner of the share will receive the capital they paid in order to buy the said share.